Hi and welcome to Swissquote's daily market talk. It's Thursday, August 7th. Market sentiment remains resilient to aggressive and hectic trade news and even to the weak US bond sales of the week. So the US dollar reverses a somewhat positive trend still, while sterling remains under pressure against the euro, at least ahead of the Bank of England meeting today that is expected to result in a 25 basis point cut. But hawkish or dovish? That's the question. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So yes, Mr. Trump continues to shape the world to his taste. He doubled tariffs on Indian imports to 50% because he doesn't want them to buy oil from Russia. Mr. Rubio, on the other hand, from his negotiation team, gently met with the Swiss delegation for negotiations. And when I say delegation, it actually includes two very important federal councillors of Switzerland, including the president herself. Well, just to leave the tariffs unchanged at 39% level, unfortunately. But hey, the meeting was apparently nice and open to further talks. However, won't necessarily ease the worries about the 150 to 250% tariffs that Trump wants to impose on pharmaceutical imports toward the United States, and both India and Switzerland are highly concerned with these tariffs, mind you. But if you look at the bright side, because the car industry, for example, which was another big victim of Trump administration and the tariffs, well, the tariffs there have finally ended up settling at more reasonable levels. So hope here is that the same could or would happen with drug makers. Let's see. But of course, because one man decides on everything as he wishes and no one can stop him, apparently, uncertainty and lack of visibility for investors will remain on the menu years to come. Then, elsewhere, Apple agreed to invest an extra $100 billion in the US production facilities to please Mr. Trump, of course, and ease his rage, because Mr. Trump, as you certainly know, doesn't want iPhones to be produced in China and nor in India, bringing the total investment promise from Apple to a whopping $600 billion as a result of the latest announcement. Now, Apple shares actually reacted to the news with a 5% rebound yesterday, showing that investors were more relieved to see Mr. Tim Cook stay friends with the White House than while seeing the company's margins being smashed by inevitably higher and significantly higher cost of producing iPhones in the US. As note that labor and assembly costs for an iPhone would actually be multiplied by at least 10. Yes, at least 10 if the same iPhone was produced on the US soil rather than China or India. So what will probably happen is that, and I think that this is the catch, well, Apple, as other companies, will be investing hundreds of billions of US dollars in their US factories and make sure that they will be highly automated to require an increasingly reduced number of labor and manforce. And it's going to be great, obviously, for AI enablers, but it may not be great for jobs that are already being significantly hit by the combination of AI and trade chaos and trade uncertainties and all of these tariffs. Now, speaking of AI, the US obviously remains a few years ahead compared with the closest rival, which is China, and AI remains one safe place actually for investors, as Jensen Huang, the CEO of Nvidia, for example, managed to woo the White House regarding its chip exports toward China. Jensen actually says that if they stop exporting chips to China, and they're not exporting their best chips, mind you, well, the Chinese would finally end up by speeding up innovation and become a, well, more serious rival. And Trump announced 100% tariffs on chip imports recently, remember, and that's the new piece of news. Yes, I didn't say it at the beginning, but TSM, a company like TSM, which builds Nvidia chips in the United States, will be exempt from that rate because they're investing in the US to build these chips, and other companies that also invest in the US will also be exempt from huge tariffs. What a world. Again, I think that AI will be accelerated as a result of these. But for now, TSM just rallied more than 4% to a fresh record high today in Taiwan, and chip stocks will certainly be reacting, well, in a mixed manner to the news depending on whether they produce or not in the US. Anyway, zooming out to a larger perspective, the US 10-year bond auction saw weak demand yesterday following a weak auction of 3-year bonds the day before. So the US 10-year yield shortly spiked to 4.28% yesterday after the auction, but the yield eased since then, and the US 2-year yield also remains under the pressure of the rising dovish Federal Reserve expectations. The Fed is not only expected to deliver its next rate cut as early as its September monetary policy meeting, but with the changes that Mr. Trump is preparing to make at the heart of the FOMC to make it more dovish and, well, friendly to rate cuts, the Fed will probably be cutting interest rates despite rising inflation. And the rising inflation problem is probably an easy fix if you can simply tweak numbers to make inflation look cooler than what it already is. This is what Mr. Trump is doing by replacing the BLS heads, and this is what actually Turkey has been doing for years. The problem is the US is not Turkey, and if investors feel that the US inflation numbers are no longer accurate and that they will be necessarily heading toward the downside no matter the reality on field, the $2 trillion worth of US TIPS market, so that's the treasuries that track the US inflation and that helps protect investors against inflation, will necessarily crack. The latter will likely further weigh on the US dollar and probably boost appetite in alternative inflation protection assets, including gold and for some Bitcoin, although note that there is no statistical evidence that Bitcoin is a good and an efficient hedge against inflation. In fact, looking at the numbers, the correlation between Bitcoin and US inflation numbers has been near flat over the period of 2021 to 2023. So Bitcoin is more correlated to risk assets. But speaking of Bitcoin itself, it will certainly continue to do well along with technology stocks regardless of inflation and thanks to Trump's supportive policies. Elsewhere, in the traditional markets, the US dollar weakens actually these days on the back of the trade news and the dovish Fed expectations. The US dollar index yesterday slipped below the major 38.2% Fibonacci retracement level on the summer rally, marking the end of the summer's positive trend here. The index is actually pushing below the 50-day moving average this morning at the time I'm talking here and has room to extend its losses on the dovish divergence of the Federal Reserve versus other major central banks, for which expectations remain dovish, mind you, but the dovishness there is mostly priced in. The Bank of England, for example, is actually expected to announce a 25 basis point cut today, but the vote split there will be the major talking point in the face of rising risks to inflation and labour market of the UK amid tariffs and Rachel Reeves tax rises. So 7 members out of 9 at the MPC are expected to vote for a cut today. 1 will likely push for a larger cut and 1 is expected to stay pat. So the expectation is 1 more 25 base point cut in November from the Bank of England. So it will be interesting to see whether the rising inflation risk in the UK could actually put that extra cut at jeopardy. So any hawkishness from the Bank of England statement today, and it will be probably playing around the mention of gradual and careful rate cuts, or the lack thereof, while could eventually give an extra hand to cable that's rising above its 100-day moving average this morning on the back of the US dollar weakness, of course, while a dovish tone from the Bank of England could hardly reverse sterling's gains against the US dollar that is being broadly under pressure. But note that the sterling's weakness is much more easily visible when compared to the euro, where the euro pound is actually pushing toward the highest level since the end of 2023, and that on the back of the deteriorating economic outlook for the UK's economy and rising inflation prospects, with a narrower headroom for government spending that could lead to more tax rises for the UK that's already suffering big time from the recent fiscal policies. So all eyes are on the Bank of England, but for now, this is all for today. I'm İpek Özkardışkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button to let us know that you enjoy these videos. So I will meet you again tomorrow, and until then, good day trading.